What's up, guys? October 10th was a bloodbath. Okay, bloodbath. Complete panic selling today on the overall markets. The Dow, the Nasdaq, the S&P slaughtered between 3 and 4% down today. Haven't seen this kind of selling pressure probably since like February, when we had that big dip in the markets in February, down to test that 200-day moving average, and we're going there again. I think we're going to go down and violate that 200-day moving average, and then eventually recover, like we did those last couple of times. As bad as today was, it was a good day for me. I locked 124% in a SPY put option trade, in at 140, out at 313 per contract. It was the 285 strike, October 12th expiration, and I left, even though I made 124% on the trade, I left hundreds of percent on the table because, guys, I exited, let me zoom, I exited my put option right there is where I got flat after this huge sell-off in the morning. Little did I know that was going to happen in the afternoon. I left hundreds of percent on the table in that options play. I'll go over the options trade with you in a moment. Just swing trade. I bought that put option last week after I saw, the heavy selling pressure that came into the markets on Thursday and Friday, very heavy volume. And I was looking for us to get below that 50-day moving average on the SPY, and I thought that would trigger some further selling pressure to the downside, and we got it. Way more selling pressure than I expected. I did not expect us to get all the way down to 277 on the SPY. I did not expect that at all, obviously, by where I ended up exiting my put option. Okay, I think that the early morning sell-off was fundamental, and I think the afternoon sell-off was technical. Okay, let's go to the daily chart on the S&P. Look at this red day. Are you kidding me? Look at that. I mean, that's just absolutely brutal. Look at the volume on that sell-off. Brutal. Here, this purple line is the 200-day. We're going to pierce that. I think we go down towards 275, maybe even a little bit lower before we put a tail in and then bounce back. Similar like we saw back here in February, and then here in April, March, and then here in May. So you see how we came down, tested that 200-day, tailed through it. I think we're going to see something similar here. I think we're going to come down, put a tail in somewhere down here before we try to bounce back up and get back up towards 285 or so. There's a couple of things that I want to talk to you about with this video. This video is more just kind of explaining to people why this happened, because I had so many members, True Trading Group members, that were asking me why this happened. For those that don't know me or don't know my background, I started my trading career working for a hedge fund in New York City. So I dealt with a lot of this. I was working at that fund during the 2008 crash. So I've been through a real market crash when like the fundamentals and everything are just completely out of whack and we were in serious trouble. Actually, 2008 is when I won the award. I won a Trader of the Year award, and that award I won actually in 2008 when it was a complete disaster. It was a 36% gain on my portfolio when, the rest of the markets were down, 40%, 50%, whatever it was, maybe more. So, I've been through, the doom and gloom. I've been through the sky is falling, and I know how to navigate that. I know how to navigate that environment. So I had a lot of people that were asking me, Mike, why is this happening? Like, what's going on? And there's a few things I'm going to talk to you about here. It's a multi-pronged reason why this happened, why the Dow was down 830 points today. Okay, and the reasons are as follows. First and foremost, the Fed is raising rates way too quickly. Okay, I am extremely critical of this Fed chairman. Extremely critical. when the economy is booming, guys, okay, you have this fear of, there's this fear of inflation. Inflation is very well under check and very much in control, is very much under control right now. There's not really a fear of this hyperinflation. And they usually say you the term when they say, wait until you see the whites of his eyes before, like, you take your shot or whatever it is. That saying. Well, that saying applies to. They also have that saying when it comes to raising interest rates, and it says you wait until you see the whites of inflation's eyes before you start raising rates. And I think the Fed is jumping the gun. I really think they're overshooting this. I think they're raising rates way too quickly. I think they're being too aggressive with it, and it will put a cap on the economic growth that the U.S. has experienced over the last couple quarters. Okay, we've been experiencing tremendous growth, but rising interest rates too quickly will stunt that growth. Okay, it will slow down the growth, and that is one of the main concerns that the market has right now. This all goes back to a speech that the Fed chairman gave last week where he said we're nowhere near neutral. Okay, which means that interest rates are not near neutral. So he's insinuating that they still have a lot more raises to go. And that is what spooked the market last week. Okay, let's go out to the daily chart. That is what caused this. Okay, now the further concern that is starting to happen now is we're coming up onto earnings season. Everyone is concerned now, well, is this as good as it gets? Okay, the growth that we just experienced, the last couple earnings quarters that we just experienced, which were the best earnings that we've ever had, corporate earnings that we've ever had, is that as good as it gets? Because if people think that rising interest rates is going to slow down economic growth, then doesn't that bode bad for future guidance? So the sentiment on the street is that this earnings season coming up, we're going to see good earnings announcements. Okay, companies are going to say, hey, last quarter we did really good, but we're not as optimistic as next quarter because we see a slowdown in growth. That's what people are afraid of. Adding on to that fear is that things are not getting any better between the U.S. and China trade talks. Okay, and companies are finally starting to feel the effects of the price increases that they're being hit with these tariffs. The cost of raw materials is going up. Okay, cost of goods is going up for companies. That will eat into their margins. Okay, which means lower profits. So if you expect the economy to slow down and you expect higher costs for companies, then the fear is that, well, companies' guidance is going to be poor. Okay, they have higher costs and the economy is going to slow down. Okay, economic growth is a rate of change. Okay, you have to understand it's a rate of change. Okay, so even though that rate of change may decrease, it doesn't necessarily mean the economy is in bad shape. The economy is in fantastic shape. Okay, the economy is in excellent shape. But is a 3 to 4% GDP growth sustainable? No, it's not. Okay, it's not. Okay, yeah, it's not really something that you can just continue on for 10 straight quarters in a row or 2 years in a row. It's just not realistic. Okay, but I think those things have coupled together here to form this concern. Okay, so you've got the economic slowdown, and then you've got the fear of that the rising interest rates the economic slowdown is going to create hawkish guidance on a lot of companies during earnings season. And then you also have companies are going to be announcing that they're finally starting to feel the effects of the price increases because of the tariffs. So that is further adding to the thought that maybe we're going to get bad guidance going forward in a lot of these names. That is why the market started selling off last week and why it sold off this morning. Why the market sold off in the afternoon, I think, is more technical. All right, because a lot of the major indices Okay, the S&P 500, the Dow Jones, the NASDAQ, the Russell, okay, broke very key moving averages today, whether it was the 50-day, the 100-day, or the 200-day. Okay, major moving averages were broken after that fundamental sell-off in the morning. Once we had that fundamental sell-off in the morning and the market was not able to recover, you got what I think is technical selling by computer programs, algorithms, black boxes. That once those moving averages were violated, it creates a blanket sell trigger in those computers. That is what I think happened in the afternoon, and then you saw the panic start to kick in. Okay? You saw the panic start to kick in. Over the last couple of weeks, it's been very common. Days that we sell off in the morning, the market has bounced back in the afternoon. Not to say it doesn't go green in the afternoon, but it would recover some of those losses in the morning. That is exactly what I thought was going to happen at 1:30. When the market broke the low of the day right here and immediately recovered that low, I thought we were going to break above VWAP and we're going to push back up to 285 and recover some of this down move in the morning. I was wrong. That's the type of action that we've been seeing over the last several weeks. Every time the market sells off in the morning, we got a little bounce back in the afternoon, almost like clockwork. Okay, almost like clockwork. Not this time. Just last week it happened. Okay, just last week it happened. Just look here. Let me pan this out. Okay, look, huge sell-off in the morning, rally back in the afternoon. Huge sell-off in the morning, rally back in the afternoon. Okay, here it is. Sell-off, rally in the afternoon. Sell-off, rally in the afternoon. That's what I was expecting to have happen again. But we never got that rally back in the afternoon. We just rolled over. And I think this was technical selling pressure versus fundamental selling pressure in the morning. And when you get that technical sell-off, guys, it speeds up to the downside, and it's not logical. It's not, it's just momentum, panic, selling, and selling begets selling. More sell triggers get triggered with these black boxes, these algorithms, and you get the speed up selling to the downside, and that's what we got this afternoon. I think it's a bit of an overreaction, but I don't think this momentum is going to slow down. I expect I expect that panic selling, and I expect that computer selling to be there again tomorrow morning off the bell. I think we're going to open up tomorrow morning, and we're going to very quickly head south. I think we're going to go down. We're going to violate that 200-day moving average. And then once that we finally put in the bottom, I think we're going to tail below that 200-day, get back up, recover that 200-day, and then we'll see a couple days of a bounce. Okay, then everyone can kind of take a step back, digest what the hell just happened, and then start to think logically instead of emotionally, and start to think fundamentally rather than technically with a bunch of computers and algorithms. That's what I think is going to happen. We'll see. That's what I am game planning for. Again, back to the daily chart, I'm looking for us to violate this 200-day moving average and then get back above it like we did here in February. See, we violated it, got back above it, and then we bounced back higher. In the end of March, beginning of April, we violated the 200-day, got back above it, bounced back. In the early May, violated 200-day, got back above it, bounced back. I'm looking for similar action now. Okay? I am turning my attention away from small caps, mid caps. I am focused on the S&P 500, the Dow, the NASDAQ, the TVIX. I'm focused on all of these ETFs. I'm looking at, the TVIX. I'll play it long. If I think we're still going lower, I'll trade the S&P. I'll buy call options once I think we bounce back and we're getting back above the 200-day. There's going to be so much volatility. Okay. Early here in February, guys, all I did was trade the TVIX almost every single day. Okay, the action was fantastic. I'm looking for that similar action now. Okay, you got to follow the money flow. You have to understand where the opportunity is. I will not be looking at these low flow morning gappers, the stock gets halted, momentum trades. I'm not going to focus on them over the next couple of days. I'm really going to focus on the S&P, the Dow, the NASDAQ, the TVIX, and see if I'm right with this 200-day and then the bounce back. Okay, I'm going to look to play the TVIX maybe long tomorrow morning if we can quick drop in the morning, get below that 200-day moving average, trigger further selling pressure from further algorithms, because if we get below the 200-day on the S&P, I think more selling pressure kicks in on algorithms and computer, black box selling. And then once we recover, then I think we bounce, and I'm going to be ready to jump on that bounce, sell that TVIX position, get long some SPY call options. There's other ETFs that you guys can trade that are, 3 times, 2 times the bull or the bear, S&P, the Dow, the NASDAQ. There's a lot of other ways that you guys can play it. That's what I'm looking for. That's what I'm going to focus on over the next couple of days. All right. The economy is in such better shape than we were in 2008. Yes, there's a lot of factors that added to this sell-off. I do think it's a bit of an overreaction. We are seeing a rotation out of high growth stocks like tech. Tech was one of the biggest that got hurt today, and it's because the Netflix, the Amazons, okay, the Alphabets of the world are now, if we're getting that economic, okay, that little slowdown, that growth sector is no longer kind of, I think we're shifting away from growth stocks and we're getting into value stocks. I know I'm talking a little bit more fundamental with you guys, and I am more of a technical trader, but I feel like it's important that you understand what is going on and why the market is doing what it's doing. Yes, I consider myself a technical trader, but I still came from the hedge fund world, which, yes, we were, a lot of our trading was based technically, but when you manage very large amounts of money, you can't just trade technically. You have to also have fundamental analysis that goes into your positions and your trade ideas and why you're long or short a certain sector or whatever it is. It's not just about, a bull flag pattern or a TTG triangle. Institutions can't trade off those patterns. Institutions have to develop positions and develop trades over a long period of time and try to catch longer moves in stocks. You can't, I can't exactly go and buy a $20 million position for a day trade. Okay. And that's, what you have to consider. So I felt like it was important that I shared with you guys my thoughts on what is going on, why we saw the sell-off like we did. I do not think the sky is falling. I do not think that the market is going back to this I do not think the market's going back to this area. Okay. Can we get to 285? Yes. Can we get to 270? Yes. Okay. But I do think that we eventually do recover long term. I don't think that we're just going to collapse. We're going to roll all the way back down. It's another 2008 and we're going to wake up and the market's going to look like this. Okay. I do not think that. The economy is still strong. Okay. Even if we get the slowdown, the economic growth slowdown, the economy is still in good shape. It's still growing at a nice rate, even though it's not going to grow at a 3.4% GDP. It's still growing. Okay, yeah, but we're not in recession type. I'm not buying any of that. Okay, there are key fundamental reasons why the market is selling off, and I felt it was important that you guys understood that. Okay, I will be looking to add to my long-term portfolios, my IRA account. Every time we got down to the 200-day moving average earlier this year, I added to my long-term accounts. Okay, I plan on doing that again in the next few days, maybe next week. All right, I think it's also important you don't try to pick the bottom of this market. Let it sell off. Okay, wait for that bottom to be put in and then catch the bounce. Okay, you don't have to be a hero. All right, but I will be looking to add to my longer term stuff. If you're a year away from retirement, then you probably need to look at things a little bit more differently than I do. Okay, but I think, 5 years from now, we're way higher in the market than we are now. So I like when the market crashes like this because it gives me another opportunity to add to my portfolios. Okay, and that's what I will be doing. The lower this market goes, I will continue to add. All right, for my longer term stuff. So, my father asked me today what, I think he should do. He's probably 1 or 2 years away from retirement. I told him that I think, he's slowly been starting to shift out of stock exposure and into some more safer stuff, but he still does have some good stock exposure. And I think a year to 2 years from now, which is his time frame, I think we're higher than where we are now. I do. Guys, listen, I'm telling you, if the Fed comes out and says, all right, we raise rates, we're going to slow down a little bit, see how the economy takes it, and then China and the U.S. trade finally come to an agreement, this will be back at 290 on the S&P before you know it. Okay, I mean that's how crazy things are. That's how volatile this market is. That's how sensitive this market is. Okay, the market is very, very sensitive. You've seen that this year, 2018. The market's been extremely sensitive. Okay, somebody sneezes, the market goes down. Donald Trump tweets, the market goes up. I mean, it's just been crazy. All right, but I still think the health of the economy is good, and I think it's intact. Okay, so I totally forgot about my options trade. I'm sorry, guys. I got so caught up in the fundamental talks of everything and telling you guys what was going on that I forgot about all of this. So here we are. Let's get to this S&P. What I noticed, guys, was last week these two big sell-off days on. At the time, you can see that was a big increase in volume, those two candles, compared to this previous volume when the market was pushing higher. And we were coming up on that 50-day moving average. The 50-day moving average on my screen right now is this teal line on my screen. Okay, and I thought if we got below it, that we were going to roll over and we were going to see some selling pressure down possibly to 280. That was my thought process. Okay, that was my game plan with, when I entered the trade last week, and I was telling all our members about my game plan and what I was looking for to have happen. And you can see we broke below the 50-day. We tried to get back above it, and then we closed below it yesterday, and that was the trigger. Okay, that closed that day right there. We tailed, closed below it. We closed weak yesterday, and that was when I was like, guys, tomorrow I think we're getting a big red day. I was in pre-market today. I was talking to our members about my position, because a lot of people were asking, what do I think? What do I think? What am I doing? And I said, guys, I expect a big red day today. I did not expect this though. Okay, I thought we were going to get down to like 284 on the SPY. Okay, I thought we were going to cut this off. I thought maybe we were going to get down to like here. Okay, literally, I had 285 strikes. Okay, I thought we were going to get down to like here. I did not expect this. I don't think anybody really expected this big of a sell-off in one day. I did think we were going to get down to 280, but I thought it was going to take a week or two to get there. I did not expect to get there in one day. I was very surprised how weak the market was today. I thought we were going to bounce back in the afternoon. I was totally wrong. We sold off even more. It was just crazy, just total weakness. The market couldn't find a bid at all. I'll take my trade announcements. Sorry, guys. Okay, here we are at 10:05. I took more profit. SPY put option 285 strike, 10:12 expiration at 2:32. That was for a 66% gain. Still holding some. And then you see here at 11:23 a.m. my final take profit. SPY put option 285 strike, 10:12 expiration, 3:13 for a plus 124% gain. That was at 11:23 in the morning. Okay, that was right there. So you can just imagine how much I left on the table. I probably left another 300% on the table. I'm not even kidding. Or at least 200% I left on the table. Okay, like in addition to the 124%, maybe more. I didn't even check where the options were trading at the close. I didn't even look at it, but I left a ton on the table there. So we'll see what happens tomorrow, guys. Like I said, I think we go lower. I will be looking for continued downside pressure right off the open. I will be looking for that, and then I will be looking for a bounce and a recovery later in the afternoon once we violate that 200-day. We'll see if it happens. I hope this video helps you guys kind of get a better understanding of why the market's doing what it's doing. I'll see you guys in chat tomorrow. Take care.